Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Bryan Noble, founder of Trader Noble, and we're coming into the end of 2017. Markets have had a stellar year. Has this asset class appreciation, has it gone too far, or have we got more to come in 2018? What's your view of certainly this year, and let's look ahead to next year?
Yeah, certainly. If you went back to 13 months ago when Trump got elected, to see where we are now after those 13 months with all the promises of the tax bill, which finally got passed the other day, it's been an incredible year. But I've been on your show many times this year. We've been bullish the S&P. We're only 100 points away now from the third standard deviation in the S&P. When Trump got elected, we were 2240. So traditionally, when we get this high above a second standard deviation, it inevitably ends in a crash. But the question is when. So I'm really watching the charts closely, looking for a sell extreme. Last Thursday's 26.51.75 reaction low. Was when Rubio switched sides before he was allegedly bought back to the tax side of things to get the next bump up. So I think between here and 27.20 is big resistance in the S&P, and I know it's the wrong time of the year to be getting short, but amazingly, if you go back in history, 31st December 1989 was the top of the Nikkei, which was between its third and fourth standard deviation, and 10 months later had fallen 15,000 points.
Incredible. With regards to the tax reforms, and the markets are very efficient, and they look ahead, so it's not really a gauge of where we are now, it's where companies or the markets expect things to be, let's say, in a year or so's time. The tax reforms, look, it took a while to get through, but they're pretty much there, bar Mr. Trump actually signing it. The reaction now from the market hasn't been, right, let's rally 10%, let's go crazy now, this tax reform's come. It's been very calm. Is it because it was all expected, now it's all priced in? And what can we expect in 2018, or maybe even looking further out?
Well, the big point is interest rates. We've seen 4 rate hikes in the Fed, one last week. They've said they're going to cut the balance sheet by 450 billion next year. This is a big factor. We've had QE, which has driven all the asset classes, as we know, up substantially over the last 7 or 8 years. Now we're going to have QT, which is quantitative tightening. 450 billion is a lot to cut the balance sheet when they're talking about another 3 rate hikes next year. I think if we get 3 rate hikes on top of the quantitative tightening, then we're going to see a huge slowdown in money supply. And then the other big factor here is, despite record unemployment lows, we still don't have any average earnings, which is a huge problem.
Yes.
So there's no inflation. And then in the last few days, finally, after the growth numbers that we're getting with the IFO survey, the growth in Germany, which has been quite substantial, finally we've seen the bond have a small sell-off. We can't get too excited. It's only 10 basis points, but at least it's 10 basis points when nobody was really expecting it in the last 3 or 4 days. So, I'm watching this 160 level in the bond is crucial. I think if we do break that, then we could see quite an acceleration in prices and a rise in yields into January, February next year.
And where do you think, if we see a fracture in the market, where do you think that's going to come from? Is it bond yields, incredibly low bond yields? Is it going to happen in the equity market? Where do you think the catalyst for an asset price depreciation could start?
But I think the bond yields could be the start of, we just don't know. But I mean, there's no point trying to say what's going to be the top of the Dow, because anybody trying to pick these numbers have just got absolutely hammered all year.
Yes.
As one level after another has just got taken out. I'm looking for sell extremes. I think that 26.51, as I mentioned earlier, is the first level in the S&P. If you go back to the 1st of December low of 26.05, which is the Flynn investigation by the FBI, when we spiked down and rallied 40 points into the close on that Friday. I think if we can take out those 2 levels, coupled with the Dow breaking 24,000, and the real support for the Dow for me is 22,000 back in the August high, which we held for ages before we finally broke it. So there should be a lot of support at that 22,000 level. So I'm kind of looking for sell extremes. If the ECB joined the party of hiking rates as well, then it's another central bank. We saw that the Swedish bank came out yesterday and said that they're ending their QE program. So things are beginning to unravel, which we didn't have at the back end of 16 going into 17. Suddenly we have this going into 18. It's another hurdle. The Bank of England, of course, hiked during the year as well. So I think the days of low rates are over, and I think the bond markets is how they react to this is key going forward.
And finally, for 2018, what should our viewers, investors, what should they have in their toolkit? I mean, how should they approach the year? What should they be looking for, and how to trade it? Is it a case of wait for a sell-off, say, in the S&P and get the shorts on, rather than trying to pick the top, as you rightly say, which is almost impossible? And if you tried it this year, you've got your fingers burnt and probably don't have any firepower left to do anything in 2018. What should an investor be doing?
Well, I'd wait till we get these set extremes. If these levels start to get broke in the S&P, then you can go short. You know where your stop is, whatever the previous high. So far, the high is just under 26.98 for the March future. So as long as we hold that, then the market might go lower. I think if we break above that 27.20 is a huge level in the S&P. I can't really see it going up without having a sell-off. We haven't had a 1% movement in the S&P for nearly 6 months now, which is just unheard of. The VIX back in the 9s again. Like, you know, these are the couple you've got to, you know, if the market starts to rally and the VIX starts going above 10, then that's another issue you've got to bring in. And the other thing that people forget about is McLennan Oscillator. Internally, the market has been extremely weak. We're barely in positive territory on the MO, which is very, very unusual when you consider all the US indices are at all-time highs. So these are a couple of worrying factors to worry. And I think the bond sell-off over the last few days with the 10-year US back up to 2.5, if we can take out the March highs at 260, then you're going to see an acceleration higher in bond yields. I don't think the equity markets are going to be able to withstand that pressure.
Well, hopefully it's not going to be all doom and gloom for 2018, but if investors are aware of what they're doing and are nimble on their feet in the market, 2018 hopefully can be another profitable year, as I'm sure it will be for you. Bryan Noble, founder of Trader Noble, thank you very much for joining us here on Core Finance.
Thank you, Matt.